Stop what you're doing. Because what you are watching right now in silver is not a rally. It is a system failure. The Western paper market has finally snapped. Not bent, not stretched, snapped. What you're seeing on the screen is not buyers pushing price higher. It's price being forced upward because there are no sellers left. This is what a liquidity vacuum looks like. And once it starts, it doesn't move gradually. It teleports. This is not price discovery. It's price surrender. For decades, New York told the world what silver was worth. Paper contracts, leverage, narratives. That era is over. Because today, price is not being discovered in New York. It's being dictated by Asia. Look at the numbers. New York silver, $78.83. Shanghai silver, $83.98. That's a $5 gap. And that gap is not noise. It is a signal flare, the Shanghai arbitrage machine. Here's what's happening behind the scenes. Algorithms don't care about headlines. They don't care about fear. They don't care about opinions. They care about math. And the math is simple. Buy silver cheap in New York. Sell it higher in Shanghai. Repeat relentlessly. As long as that gap exists, buying pressure in New York becomes price inelastic, meaning price does not matter. The buying continues regardless. This is not speculation. This is arbitrage extraction. And it drains physical metal from the West every single time a contract clears. Why this is unstoppable. To close the gap, one thing must happen. New York must rise, not because traders want it to, but because physics demands it. Western vaults cannot bleed metal indefinitely. At some point, price must rise high enough to stop the outflow. That level is not 79. It S not 80. It S wherever Asia says it is. Now add the short squeeze. This is where it turns violent, because while arbitrage is draining supply, short sellers are being crushed. These aren't retail shorts. These are funds, banks, structured desks, and they were positioned for control. Instead, they got run over. When price moves this fast, short losses explode nonlinearly. At a certain point, margin calls trigger forced buying, not optional buying, mandatory buying. That buying hits a market with no offers, no liquidity, no sellers. This is how squeezes go vertical. The gamma feedback loop. Now layer in options. Call options that were safe suddenly go in the money. Market makers must hedge. They buy futures, which pushes price higher, which forces more hedging, which triggers more stops. This is a gamma squeeze, a self-feeding loop, and it does not stop until something breaks. Gold just confirmed everything. If this was a silver-only move, you might question it, but it isn't. Gold just surged $135 in a single move. That's nearly 3%. In gold, that's a black swan. Gold does not move like that unless something systemic is happening. This is not a trade. This is a confidence event. Silver is not leading gold. Gold is validating silver. And because silver has high beta to gold, when gold moves 1%, silver moves 2-3%. That's exactly what you're seeing. Textbook behavior in a non-textbook environment. This is not a bubble. It is a reset bubbles form when supply is abundant and demand is emotional. This is the opposite. Supply is constrained. Demand is mandatory. This is not retail mania. This is institutional repricing. The biggest mistake people make is thinking fast price movement equals speculation. No, fast price movement equals absence of liquidity. Industrial buyers. Just flipped the switch. Now let's talk about the most dangerous force of all, industrial demand. For manufacturers, higher prices don't signal too expensive. They signal not enough supply. That flips behavior instantly. Just-in-time inventory becomes just-in-case hoarding. Solar manufacturers, electronics firms, defense contractors, they don't buy because price is attractive. They buy because production must continue. This creates an inventory supercycle. And once it starts, it feeds on itself. Higher prices, more hoarding. More hoarding, less availability. Less availability, higher prices. That is how commodities break systems. The physical market is locking up. Now look at what dealers are doing. They're not celebrating higher prices. They're pulling inventory. Why? Because wholesale prices are chaotic. They can't hedge fast enough. So they widen premiums or freeze sales. That tells you everything. When dealers don't want to sell during a rally, it means the rally is real. The paper price says $78. The physical price is whispering $95, $100, and rising. Who's really setting the price? Now, let's be clear. New York no longer sets silver prices. It reacts to them. Shanghai is leading. Physical demand is leading. Inventory availability is leading. Paper is following. Late. That's why price feels like it's jumping, because it is catching up to reality. And above $80, there is no history, no resistance, no roadmap, only psychology. Why selling? Here's a trap. This is the moment people get clever. They see profit. They think, I'll sell here and buy back lower. That works in normal markets. This is not one. Selling silver for dollars during a currency confidence event is like trading your lifeboat for a seat back on the Titanic. You might feel smart for a moment, until you realize there is no way back. The mania hasn't even started. Understand this clearly, retail is not here yet. This move is driven by arbitrage, institutions, industrial buyers, systemic hedging. The public phase comes later, that S when headlines turn euphoric, friends ask questions, media changes tone that says the mania phase, and historically, that's where silver goes parabolic. $80 to $150 doesn't happen quietly. It happens loudly, and we're not there yet. The gold-silver ratio confirms it. Look at the gold-silver ratio, currently around 56:1, mania peaks. Historically occur at 20:1, 15:1, even lower. That means silver can dramatically outperform even if gold stalls. The math says upside. The flow says upside. The structure says upside. This is not over. It's just begun. Now here's the part most people are not psychologically prepared for. Because once silver clears $80, the market changes character. Above $80, welcome to blue sky. There's no chart resistance above 80, no historical ceiling, no technical memory. And what's left are round numbers, and round numbers don't stop markets. They accelerate them. 80 becomes irrelevant. 90 becomes a waypoint. 100 becomes a magnet. Why? Because in a broken market, price doesn't move to where it should. It moves to where it must. Why moves? Get faster, not slower. People expect rallies to exhaust themselves. They expect higher prices to attract sellers. That logic depends on one assumption, that sellers exist. Right now, they don't. Every ounce that comes to market is already spoken for. Industrial buyers, arbitrage desks, funds reallocating. There's no one waiting patiently to sell you silver at 85, which means when price jumps, it jumps through air. This is how you get $10 days. This is how exchanges halt trading. This is how price gaps while you're asleep. Volatility is not the enemy. Leverage is here's the mistake that wipes people out. They confuse volatility with danger. Volatility doesn't kill you. Leverage does. Margin, options, short-term futures. Those are weapons that work only when markets behave. This market is not behaving. It is unwinding decades of distortion. If you are leveraged, you are not in control. The market is. And this market will show no mercy. The only asset that matters now, in a liquidity vacuum, paper claims or liabilities, ETFs promise exposure. Futures promise settlement. Options promise leverage. But only one thing promises certainty: physical possession. Not ounces on a screen, not shares in a fund, actual metal. Because when delivery becomes scarce, claims become negotiable. And negotiable claims are not assets. Why physical price will lead everything. Here's the most important shift happening. Physical is no longer following paper. Paper is chasing physical. That inversion changes everything. Premiums widen first, availability disappears next. Then paper panics. By the time spot price confirms the move, the metal is already gone. This is why waiting for dips in a physical shortage is a losing strategy. Dips exist on screens. Shortages exist in reality. Ignore the noise. Follow the signals. You're going to see headlines. Silver overheated. Silver due for correction. Silver bubble forming. Those headlines are written by people who do not deal in metal. They deal in narratives. You don't need narratives, you need signals. And the signals are clear. Shanghai premium, physical availability, gold-silver ratio, dealer behavior. Those tell the truth. Everything else is noise. Why selling for dollars? Makes no sense. Ask yourself one question. What are you selling into? A currency system with record debt, a bond market under stress, central banks trapped. Silver is rising because confidence is falling. Selling silver for dollars in that environment is not profit-taking. It's risk transfer. You're giving up a scarce asset for an abundant promise. That trade only makes sense if you believe stability is returning. Nothing suggests that. The right exit is not dollars. Let's talk strategy, not emotion. You don't exit silver into cash. You exit silver into value. Historically, the cleanest signal is the gold-silver ratio. And when silver is undervalued, the ratio is high. When silver is overvalued, the ratio collapses. Mania peaks historically around 31, start paying attention. 20.1, scale out. 15.1, exhaustion. That's not prediction, that's pattern. Until then, silver is the trade. The hardest part is not buying, it's holding. Most people fail here, not because they're wrong, but because they get scared of being right. Big green candles feel good until they feel terrifying. Your brain starts bargaining. What if I lose it? What if this is the top? What if I sell now and re-enter? That's how strong hands become weak. Conviction isn't built at the bottom. It's tested at the top. Remember what this move represents. This is not a silver story. It's a trust story. Trust in currencies, trust in systems, trust in price discovery. Silver's simply where the fracture is visible first. And when fractures show, they don't heal quietly. This is the repricing phase. Suppression ends quietly. Repricing happens violently. The move from 50 to 80 was the warning. The move from 80 to triple digits is the consequence. This is not a trade cycle. It's a structural reset. Final message. Do not let screens shake you out of what fundamentals have handed you. Ignore the noise. Ignore the intraday chaos. Ignore the commentators who arrive late and leave early. Watch the metal. Watch the vaults. Watch Asia. Because the West just lost control of the price, and it's not getting it back. This is not the end of the move. This is the beginning of the part people talk about for decades. Hold steady. Stay unleveraged. Think in ounces, not dollars. The squeeze is on, and it's just getting started.